In today's video, we're going to be doing a deep dive on leverage and take a look at the role that it's been playing in market volatility over the last year or so, and really even beyond that. Right now, leverage is sitting at levels that we have never really seen before. Margin debt, which is the money retail investors borrow from their brokers to buy more stocks, hit almost $1.5 trillion in May. That's an increase of almost 54% from just a year earlier, and globally, leveraged investors are now deep enough into government bond markets that the IMF is actually writing about it as a financial stability risk. So what I want to actually answer in this video are a few questions. Has leverage use gone up or down? Who is trading with leverage? Is it mostly retail or institutional investors? And what does the use of leverage mean for market volatility? We're going to start with the domestic picture, and then we're going to go beyond that to the international picture. So let's start with the most visible form of leverage, which is margin debt. This is the money that individual investors will use to borrow against their brokerage accounts in order to buy more stock than they can actually afford with cash. And FINRA actually tracks this every single month, and the trend over the past year has been one of nonstop growth. Margin debt crossed $1 trillion for the first time in June of last year. And by December, it was at $1.25 trillion, which was the seventh straight month record at that point. It kept climbing into this year as well, and it hit $1.33 trillion in April. Then in May, we reached just about $1.5 trillion. Year over year, that's a greater than 50% increase. And just as a comparison, the S&P 500 was only up around 20% during that stretch. So borrowing is actually growing more than twice as fast as the actual market that borrowing is funding. And there's a second piece of this retail leverage story that doesn't really show up in the margin debt number. Leveraged ETFs, which are funds that use derivatives to deliver 2 or 3 times the daily return of an index, have pulled in another $250 billion from retail investors. Now, they're still a small slice of the over $13.5 trillion ETF universe, but they are already making up around 12% of daily ETF trading volume. That is not a small slice. And the thing that most people don't realize about these funds is that they tend to reset their leverage every single day. Going back to margin debt, let's look at some history. Margin debt has almost always moved with the market. When stocks rally, people will borrow more to ride that rally, and when stocks fall, margin calls force people to sell, and that selling is part of why sell-offs accelerate the way that they do. None of that should be new. What is new, though, is just how far that relationship is stretched. Since 1997, margin debt and the market have generally grown in lockstep, but a gap opened up after the dot-com crash, and really it's been widening ever since. As of this year, real margin debt, adjusted for inflation, has grown over 500% since 1997. And in this time period, the market itself has only grown by around 330%. So borrowing is outpacing the actual asset that it is funding, in spite of a pretty wide margin. And that gap is at its most extreme point on record, and I don't see it slowing down anytime soon. And there's a pattern in this data that I think is interesting. Many researchers have noticed that the lowest points in investor credit, which is referring to the point where investors have the least cash cushion relative to what they owe, have historically shown up right before market peaks. 6 months before the peak in 2000, 4 months before 2007, 4 months before 2018, and 2 months before the 2021 peak. And in the most recent cycle, that lag has disappeared completely. The credit low point and the market peak happened at essentially the same time. So the warning window that used to exist really has been shrinking every cycle. And I want to be clear, I don't think that a crash is coming tomorrow. But what I am saying is that retail investors as a group are walking into this market with less of a cash cushion and more borrowed money than at almost any point in history. Retail margin debt gets a lot of the headlines because it's a clean number, it gets updated monthly, and therefore it's very easy to point to. But retail is a smaller piece of the leverage story. The bigger story, as I'm sure you can imagine, is happening inside hedge funds. And it's happening in both the equity markets and the treasury markets. Hedge fund gross exposure across every asset class climbed past $33 trillion, which is roughly 2.5 times where it was sitting back in 2013. One of the fastest growing pieces of that exposure is treasuries and interest rate derivatives. And the reason for that comes down to a trade called the cash futures basis trade. Basically, a fund will buy an actual treasury bond and at the same time, it will sell a Treasury's future contract on a similar bond. And then they pocket that small pricing gap in between the two. On its own, that gap is tiny, basically nothing to these portfolio managers. And so to make it worth it, funds will borrow heavily to scale into that trade where that tiny gap turns into real money. This trade, though, it depends entirely on funding conditions staying calm and stable. If funding tightens up suddenly, funds get hit with margin calls on positions sized in the millions or even the billions of dollars. And then they're forced to dump the actual treasuries just to raise that cash fast. And this is exactly what happened back in March of 2020, when this same basis trade unwound, and the Fed actually had to step in order to stabilize the treasury market. Let's zoom out from the basis trade and just look at hedge fund leverage broadly. Because the picture there tells basically the same story, that leverage continues to climb. Goldman Sachs has brokerage data that tracks the actual borrowing that hedge fund clients use to run their books, and it shows that gross leverage rose for a third year in a row to the highest level on record by the end of 2025. Net leverage, which strips out offsetting long and short positions to show you direct market exposure, is sitting near 3-year highs as well. And this growth is not just a US story either. Non US markets, especially emerging markets, actually led the pace of increase last year. Gross and net allocation to emerging markets outside of China has risen to record highs. And the actual borrowing behind all this leverage breaks down into three channels: prime brokerage financing for equities, repo financing for fixed income, and securities lending. Repo borrowing alone hit $2.5 trillion at a recent peak after 8 straight quarters of growth. And that growth was driven almost entirely by the Treasury basis trades that we just talked about. And here's the thing that I want to highlight: the banks that are providing all this financing are not just the small players, they are the largest and the most important banks in the entire world. This means that if hedge fund positioning unwinds in any serious way, it doesn't just stay contained to hedge funds. It runs straight through the balance sheets of the banks that financed it in the first place. As I mentioned, leverage is not just a US phenomenon, and the international data tells us a very consistent story. Governments and leveraged investors are both expanding their footprint in fixed income markets at the exact same time, and that's something we need to pay attention to. Globally, total debt across governments, households, and corporations hit a record $346 trillion in the third quarter of last year, which is up over $26 trillion in just 9 months. Sovereign bond debt across the 38 countries in the Organization for Economic Cooperation and Development reached an all-time high of $61 trillion. The IMF's most recent Global Financial Stability Report actually points to leveraged fixed income arbitrage trades, like the basis trades here in the US, as a vulnerability that is now embedded across multiple government bond markets, not just in treasuries. There's a specific risk that actually connects to a topic that I've discussed in multiple videos. As interest costs rise, governments have been shortening the maturity of their borrowing. They're issuing more short-term bills and fewer 30-year bonds because it's just cheaper to do so at the moment. And the ratio of long-dated to short-dated issuance hit its lowest point since at least 2008 last year. Now, these are rational decisions for any individual government to make, but it creates a collective problem. More government debt now needs to be rolled over constantly, which means more of it is exposed to whatever interest rate environment exists at the exact moment that it gets rolled over. And this means more sensitivity to the same kind of leveraged investor stress that we discussed earlier. So here's where this actually leaves us. Retail leverage is at a record. It's growing faster than the market it's actually funding, and investors have the smallest cash cushion on record. Hedge fund leverage is also at a record, and a big chunk of it is concentrated in a treasury basis trade that depends entirely on funding conditions staying calm. And all of that leverage sits on the balance sheet of the same handful of systemically important banks globally. The takeaway I want to leave you with is that leverage is not necessarily a good or bad thing on its own. It's all about how the leverage is used. Leverage can amplify wins, but it can also amplify losses. So it is always best to fully understand leverage before using it, whether it is through margin or leveraged ETFs, and to use leverage in a responsible way. I also want to mention that with leverage becoming a larger and larger part of the market, volatility is going to continue to increase. This will look like more violent moves to the upside and aggressive rips to the downside. And all of it has to do with the movements that leverage positions require, like daily rebalancing, margin calls, etc. That is going to do it for today's video, guys. Leverage is one of those topics that doesn't get talked about much, considering how much it actually drives the moves we see in markets. If you found this useful, drop a like, subscribe to the channel, and check out my other videos. Let me know what you guys think in the comments and if you guys have used margin or leverage in your own trading. Personally, it's a part of my portfolio, but I'm always curious to hear from you all. Thanks for watching, and I'll see you in the next one.